Okay, so we're going to look at the money supply. And your learning target is that you can compare the different types of financial institutions and then explain the role of money. So we have 4 focus questions today. We're going to look at what does the money supply consist of, what is a Federal Reserve note, what is and what is not money, and then what causes interest rates to change. We have some key terms here. We have money supply, currency, Federal Reserve note, savings account, mere money, and then the loanable funds market. So what are the components of the money supply? Well, there's this thing, it's called M1. It includes funds that are readily accessible for spending, meaning money that's on hand that you can spend for whatever it is that you want to purchase. So M1 consists of 4 parts. The first part is currency, that's outside of the United States Treasury, meaning it's not being held. Money that's outside of the Federal Reserve banks, again, meaning it's not being held. And then money that's outside of vaults of depository institutions, which just means banks. Okay. Second is what are called traveler's checks, and these are non-bank issuers, and I'll explain what those are because it's kind of an antiquated thing. But 3, and then demand deposits. These are checking or savings accounts. So demand deposits are 2 things. It's either a checking or a savings account. And then 4, it's what are called checkable deposits. These are also known as OCDs, and these consist primarily of what are called negotiable orders of withdrawal, or NOWs. This is a type of account at like a bank or a credit union, and then they share what's called a draft account. OCD and NOWs would be more like for financial institutions or businesses. So we have 2 kinds of money in the United States. Well, anywhere in the world. We have what is called M1. This is money that's like readily available to spend, and then M2. This is like assets that you have but aren't readily transferable into funds. So like this is how much money is in circulation in the United States. Okay. And notice this is in the trillions of dollars. And then M2 is the amount of money that's in M2, or value of M2. This is things like your home, stocks and bonds, things like that. Things that you could sell for cash, but aren't in cash. Okay, so this is like the amount of money in circulation, and then this is the amount of value. Okay. So let's look at currency first in the United States. It includes both coins and paper money. Now, coins in the United States are printed at the U.S. Department of Treasury, and our paper money is printed and distributed by the Federal Reserve. So it's not the same. Okay. This is what a Federal Reserve note is. Okay, it's also still called a greenback. It replaced the old money that we used to have called the United States notes, which they used to be issued by the Treasury Department, but now they're called Federal Reserve notes because they're issued to us through the Federal Reserve. Okay. So the Federal Reserve System, which is also known as the Federal Reserve, or just simply as the Fed, it is the central banking system of the United States of America. However, even though it's our central bank, it's decentralized, and we'll talk about that later in a different lesson entirely. So the Fed was created back in December 23rd of 1913 with the enactment by Congress of the Federal Reserve Act. And the reason why this came about is because of like decades of what are called financial crises or panics. Now, particularly the 1907 financial crisis was really bad in the United States, and it was wealthy individuals, particularly J.P. Morgan, that like bailed out the U.S. government, and members of our government thought maybe it's not a good idea for democracy if like one man or a small group of people has to keep the economic system of our country propped up, and so they passed this law. Now, events like the Great Depression specifically in the 30s and then the Great Recession in the 2000s have expanded the role and the responsibility of the Federal Reserve System by Congress. Okay, that's important. Another form of M1 is a checking account, and so somebody who is a holder, what they do is they deposit money, like from their check or whatever, and then they're able to withdraw that money that they've deposited in the form of like a check or like a debit card. Okay, So this type of account is also referred to as what's called a demand deposit, because you can take the funds that are in the bank and you can convert them to currency on demand, or by writing a check, which is payable to somebody. And if you're not sure what a check is, this is what they look like. Okay, it's going to have your name, your address right here. You fill in the date in which the check is going to be when it's written. Then you put here the name of the person or the institution that you're paying. You put the dollar amount to the penny right here. So like, let's say it's for $100, you put 100.00, and then see it's written in dollars, so you would write 100, and then since there's no pennies here, you would write 00/100, which means no pennies. And then the memo, that's just for you, like, why did you write this? It could be cash. And then this space right here, this is where your signature goes. Okay. Now a check is made up of different parts. This is the routing or the transit number. This is what tells the not the cashier, but the machine the cashier is using, like, am I getting the money from? Okay, this is the institution's number, your bank's number, and then this number right here is your account number. So this tells the institution where to withdraw the money from, and then this is the check number. Okay, these two things will match. Then we have a thing called a traveler's check. Now, back in the old days, people would go from one country to another. Say I'm going to Mexico or Australia or France. I would get a traveler's check because you can't use US dollars in those countries. So what you do is you would go to a bank here in the United States and you would say, I would like a traveler's check for $50 in Australia. And they would issue this thing. Okay. When I went to Australia, I could use this as though it were actually 50 Australian dollars. Okay. The nice thing about this is if it's lost or stolen, you can call the institution which has issued this and they can issue it back to you. Now if you notice on the bottom here, right, this is very similar to the check, and that's why it's called a traveler's check. Okay. So these aren't really used that much anymore, and the reason why is because we have things like prepaid credit cards. You can go to an ATM pretty much everywhere and anywhere. They'll charge you money to withdraw money from it, but like, I mean, I personally have used my own credit card, or not credit cards, but debit cards. Like if I was in China or in Australia or Bahrain in the Middle East, you can put your debit card in there, and it's going to charge you a fee. But if you accept that fee, then you can get out in dinars or Australian dollars or yuan that amount. Okay, so these are still included in M1, but they're just not as popular as they used to be. And then we have to ask ourselves a question, which is, are savings accounts money? So a savings account is an interest earning account, meaning I put my money in the bank, not in my checking account, but in a savings account, and I can earn interest on it. Now how much interest you earn is extremely small, okay, 0.01%. So a savings account that allows for check writing privileges, that's considered to be a checking account. Okay, and then you have this thing right here. It's a passbook, and what you would do is you would write down your information. This stuff is still used, but it's not as commonly used as it once was because we have like apps on our phones which will do this. But like, I can tell you, like my wife, she still does this. Like when we take money out of a savings account or a checking account, we have the passbook and we still fill it out, and you want to make sure that the numbers that you have match the numbers that your app has from the bank, because it can be different. Now a non-check savings account is not considered money, okay, because it's not widely accepted for purposes of exchange. The difference between the two here, if you're confused, is if I put money in a savings account that allows me to write a check, I can immediately draw upon that money. It's on demand. However, if it's a non-check savings account, meaning I have to go to the bank and go to a teller and then withdraw money that way, that's not on demand. And so it's not considered, non-check savings accounts are not considered to be part of M1 because it's not on demand. Okay? Instead, what we call this is near money. Okay? This is an asset, like non-checking savings account, that can easily and quickly be turned into money, but are not instantaneous. Okay? Are credit cards money? No, they're not. A credit card is not considered money, and the reason why is because money has to be able to be acceptable as a form of payment and repayment, and a credit card cannot be used to repay debt. Okay, a credit card is actually debt because it's placing you, the person that's using that credit card, in debt to the bank or whatever institution it is that's issued that card. So it's not money; it's debt. By the way, this is the credit card burden for each state per person. So in Michigan, the average credit card burden is $7,382. That's a lot of money. Okay, so how do we figure out interest rates? Is that just magic? No, it's not magic. It's the same idea that we've worked with in chapters 3, 4, 4, 5, and 6. So we have demand for loans, and then we have supply for loans. And where those two things intersect, that's our equilibrium, and we call that the real interest rate. Okay? So why do interest rates go up? Well, because of changes in supply and demand, just like you're aware of. Like this can shift to the right or shift to the left. Same thing with the demand side, right? And so through this interaction, that's where we get our interest rate. Okay? That should be nothing new for you. It's just the labeling is different. So instead of this just saying supply, it says loan supply. Instead of this saying demand, it says loan demand. This is still quantity, and this is not price anymore, but like it's the interest rate. Okay. So interest rates are determined in what's called the loanable funds market, and all this is it's the marketplace for loans. So there's a demand for loans. These are people that are looking to borrow, and there's people who are willing to supply loans. These people are called lenders. And then through this interaction between the two groups, we determine what the interest rate is. Okay. So when we look at who is it that's supplying loans, we call these people the lenders. And then when we look at who is it that's demanding loans, we call these the borrowers. And so, as I said, like where the supply and the demand curves intersect, that's what determines the interest rate. Now, what happens if the interest rate if the demand for loans decreases? Well, what would happen if you think about it, right? If interest decreases, it's just like price, right? So on the demand side, meaning the borrower side, if interest rates are lower, then their demand for them increases. And then what would happen if interest rates on the supply side increased? Meaning the people who are supplying loans, the lenders, are going to get more money for the loans that they make. Well, they're going to make more of them. Okay? And so you can have the same exact thing that we've had before, where you've got demand, you've got supply, and they shift. Remember, the labeling is important. So SLF, which stands for short-term loan, and DLF, demands for loans. That stands for supply for loans, not short-term. That's different. This is the origin right here. There's A, boom. But if demand decreases and supply decreases, there's no change. Okay, they're still the same. Now the number of loans has decreased, but the rate has not decreased. And you guys should be able to do all of these things because, like I said, we've been doing these things since chapter 4. Whether it's for supply and demand, whether it's for wages and like determining unemployment, all this is doing is using the same exact principles that you've already learned, but applying them to interest rates. Now there are different types of loans, and then they have different interest rates. So a short-term loan is generally a loan that's going to be repaid in like maybe a few months or about a year. Okay, and interest rate for these types of loans are called short-term interest rates. And this could be a small business loan, like maybe they need money to pay wages or something like that. It could be a cash advance or a payday loan if you need that. And then it can also be the interest rate for a credit card, because typically a person's credit card is 1 month. So like you borrow money on it, and then in a month you can either pay it back at 0% interest, or if you're going to carry that amount of debt over to the next month, well, this is how much you're going to be paying on it. Okay, so it's not necessarily a set amount, you guys. It can change month to month. And then a long-term loan is a loan that can take like a couple of years or a few years, or it can include decades. Okay, and the interest rate is referred to as the long-term interest rate, and this is on cars, homes, things like that. So like if you get a car, brand new car, and you want to take out a 4, 5, 6 year loan, you can, and you can figure out what the interest rate is going to be based on that. Same thing with mortgages. You can get a 15-year mortgage, you can get a 30-year mortgage, and it's going to have a different degree of interest based on the length of the loan. Same thing, okay? There's no changes here. We're more than used to say this. This is a change in supply. I'm sorry, I don't know why I say that. This is a change in demand. This is a change in supply, okay? But notice, short term versus long term. You want to look at those things to make your determination of what's happening. Okay, so what's the official name of a dollar bill? Well, it's a Federal Reserve note. Okay, all of our money, whether it's a dollar bill or a $5 bill or a 10 or a 20 or a $100 bill, they're all Federal Reserve notes. Okay, because the Federal Reserve is the institution which institutes that. They print them. Okay, get them out to us. That's it. Okay, thanks a lot.